Partnership insurance. Let us understand partnership insurance through an example. There is a partnership firm, where there were three partners, Mr. Suman, Mr. Anik and Mrs. Damani. In this partnership firm, Mr. Suman have invested a capital of rupees 5 crores, Mr. Anik has invested a capital of rupees 3 crores while Mrs. Damani has invested rupees 2 crores. When Mr. Suman has an expertise on marketing, Mr. Anik is skilled on production and Mrs. Damani is the master of administration. Because of the knowledge, expertise and fine-tuning of these three partners, the partnership firm started to grow very fast, and achieved success and goodwill. But suddenly Mr. Anik died on a road accident, and there came a big setback in the partnership firm. As partners of the firm, Mr. Suman and Mrs. Damani has three options to decide from. Option number 1 is to take Mr. Anik's wife as partner, who has no expertise on production, and keep on sharing the firm's profit with her, as long as the partnership firm exists, and also to appoint someone to manage the production. From the business point of view, it is a loss from the profits to the living partners. Option number 2 is to separate Mr. Anik's family from the partnership firm, by refunding the invested capital of Mr. Anik, along with his business goodwill share. Goodwill means the last 3 years' net profit, which is gross profit minus income tax paid. As the last 3 years' net profit was rupees 30 crores, the percentage share of those three partners, as goodwill stands, as Mr. Suman's 50%, that means rupees 15 crores profit. Mr. Anik's 30%, that means rupees 9 crores profit, and Mrs. Damani's 20%, that means rupees 6 crores profit. At that juncture, the value of share in the said partnership firm is rupees 20 crores for Mr. Suman, rupees 12 crores for Mr. Anik and rupees 8 crores for Mrs. Damani. So, to remove Mr. Anik's wife from her rights to the partnership, the other partners have to pay her back the value of Mr. Anik's share and has to immediately arrange that rupees 12 crores, either from the profit or capital of the firm, or by selling assets of the firm or by taking loan. In all the three ways of repaying, there is always an unnecessary capital drain to the firm, and many times it is observed that, in such scenario, the firms were sold or closed, owing to non-availability of sufficient working capital. Option number 3 is to search a new partner, who is like-minded, equally skilled as Mr. Anik, and can invest rupees 12 crores in the firm. In most cases, all the parameters are hard to be met. Among those three options, generally option number 2 is the widely used option by the partnership firms, in case of such setback. But only 10 to 20% of the Indian firms are smarter to manage this setback by having partnership insurance. Partnership insurance is basically the term insurance taken on the lives of all the partners of the firm simultaneously, based on their share in the firm. Let us see how smartly the partners of the discussed firm could have avoided this setback. If the partners of this firm were smarter, to have 3 term insurance policies, one of rupees 20 crores on the life of Mr. Suman, one of rupees 12 crores on the life of Mr. Anik and one of rupees 8 crores on the life of Mrs. Damani, today the firm could have easily paid rupees 12 crores to Mr. Avik's wife from the death claim amount, and every year could have claimed all the premiums paid by the firm for these 3 insurance cover, as business expenses, under Section 37(1) of Income Tax Act. The respective premiums would not have been attached as perquisite in the partner's account as well. The death claim money would have been added in that year business income of the firm, but simultaneously as it would have been paid to Mr. Avik's wife, the tax liability on that income would have got nullified. The same setback might have come to the firm, even within some days of forming the firm. Right or wrong? So, it was always smarter for those partners to have partnership insurance, right from the inception, by clearly stating in the partnership deed about the compulsion of having partnership insurance equivalent to the amount of their share value in the firm, and were required to get adjusted every year, according to the goodwill of the firm, and by authorizing one of the partners to sign all insurance contracts on behalf of all the partners. It is to be noted that copies of audited profit and loss account, balance sheet, capital accounts and income tax return for last 3 financial years are generally required. Don't worry if the firm is new, only the partnership deed would suffice. The same setback could also come, to meet up the hospitalization cost, if one of the family members of any partners are diagnosed of severe illness, as that partner may withdraw money from the capital of the firm for their treatment. So, it is always smarter, wiser, visionary to add family health cover of at least 25 lakhs in your partnership insurance. I wish you can now understand why smarter businessmen are taking partnership insurance. Still, if you have any doubt, leave me a comment to answer. Stay happy, healthy and protected.